Hi, I'm Peter Rose, founder of Longwood Currency Trading. How do you execute the most important Forex trading rule that there is? Well, Peter, what's the most important Forex trading rule before we get to how to execute it? In working with folks through email and courses and stuff, it's interesting that when we talk about Forex, the conversation seems to always go, when it starts out in talking with me, when do you get in? How do you do this? And how do you do that? Like there's a magic solution to that. There is a magic solution, but it's not when the short MA crosses the long MA or something like that. The magic is in process. And so the most important Forex trading rule that you can have has to do with risk management, right? And risk management is a process. You can't just pick one thing out and say, boom, I do this and everything's going to be okay. The principles behind risk management are to not lose any more than is absolutely necessary on that trade. And whether that's a stop, exit, or whether it's a moving price that you're exiting when you get out of that. So the rule that you have, and this is obviously during position management, because you have entry analysis, position management, and exit methodology. Those are the three phases of what I call the life cycle of a currency position, which is a rip on my 33-year career as a software engineer designing complex business applications. How do you, called the SDLC, how do you solve a complex computer problem? The SDLC shows you how to do that. How do you solve the complexity of the Forex market? It's through the life cycle of a currency position, entry analysis, position management, and exit methodology. So what the most important Forex trading rule encompasses is a blend between position management and exit methodology. And that most important rule is get out of that trade when it's not looking good. Now, if it's entry, then that's kind of taken care of in your entry analysis where you set your entry stop. And I've talked about that. That's simple. You just do it. But the more complex issue comes in, I set my profit target and the price is moving and for some reason I don't make any profit. The price has moved in the direction that you thought that it should move in. It's gone past the entry point. You're 5, 8 pips in, 10 pips. I mean, wherever your skills lie at that particular time, it's there and the price is moving. And you're saying, oh boy, this is going to get to my profit target. In saying that, you're violating a risk management rule. The profit target isn't where you're trying to get out of the trade. The profit target marks the upper boundary condition as you perceive it. The profit target is the upper boundary condition. The boundary condition is where a lot of order flow has been going on in the past. You do not want to think that you're going to go through that order flow. You're going to get jammed up in there if it's a heavy order flow. How do you define heavy and light order flow? That's a topic for another discussion. We're not really talking about the profit target other than saying that the profit target is the most you would expect the price to go. So the correct profit target is probably less than where you're putting it. And that might be where you're getting stuck trying to get too far on a particular trade. You can't just say, oh, I'm going to get 20 pips today, I'm going to get 30 pips today, because how do you know? But what you can say is, where are the boundary conditions of my position? You know, if you get into a trade where the lower boundary condition is above where your normal stop would be and it's short, then you can't get into the trade. Boundary conditions set the theoretical limit of where price is going to go, and it's based on the time frame of the chart that you're trading on, that you're making your decisions on. Sure, you can make your trend probabilistic determination on the 4-hour. Maybe you want to go to the daily. I don't think that's necessary, and I don't think the bank traders are up on the daily. They're in 4-hour trade, and there's a reason for 4 hours as being an interesting trade for institutional charts to look at, institutional traders to look at 4-hour chart. But if you're a day trader, you're trading down on the 5-minute chart. I mean, once you get into position management, you may be in 1 minute or 5 seconds. I mean, I don't know, but you're setting your trend stuff up on the multiple time frame is for trending, 4-hour and 15-minute combined. And then on the 15-minute, once you get your trend, the 15-minute is somewhat in confluence with your 4-hour. Then you're using the 15-minute to say, oh, okay, these are the boundary conditions of my trade. This is the lower boundary and this is the upper boundary. Now you've got a position that's in movement, and you're 3/4 of the way to your quote profit target, and you're going, oh boy, this is going to get my profit target, and it might be another 5 or 8 pips. So that could be $500, $800 to you on a large account. Could be $50, $80 more on a smaller account. So you're hoping for that next 5, 8 pips. And there's the danger. Now you start focusing on having that price get to that profit target. But you're not looking at the price action correctly. You need to drill it down onto a shorter time frame so that you can look at what's really going on. Because there are little stagnation periods on that 5-second and 1-minute chart that you're not going to see up on the 5-minute or the hour or whatever it is that you're doing. So the most important Forex trading rule is to get out of a trade when the trade starts to what I call chatter. When you look at the price action on a long-term chart, you're not going to see chatter. You're not going to see the price go like this and then start to go like that. In other words, price is not moving the way that you thought that it should. You thought that price was going to go from your entry point toward your profit target and get close to that profit target. And, 2-3 pips, or it would get to that profit target. Well, first, that's wrong. You have to look at nature around you. You go to a stream and there's a boulder in the middle of that stream. So the water is rushing toward that boulder. But that water starts to part before it gets to the boulder. The water just doesn't go up even like this to the boulder and then all of a sudden part. It starts parting back. The boulder's here. That water starts parting way before you get to the boulder. Why is that? That's just the process of nature. And so as you approach your profit target, which should correctly be at a congestion zone, a structural area of order flow, you have to start watching for that price to react. If it doesn't react in a chattering type fashion, well, Peter, what's chattering? Well, we're getting off track here. But as that price approaches further and further along in its journey toward the profit target, you have to be aware of if it's going to be experiencing chatter or not. As soon as it starts to chatter, get out. Could you make an extra 3 or 4 pips? Sure you could, but you could also, from that chatter, get an 8 or 10 pip loss just like that. You've seen those prices turn around, and what is it called? Called a pin bar, right? So the terminal point of a price action which will form a pin bar is in a chatter event. Now, those pin bars are more important up on the hourly chart or the 4-hour chart than they are on a 5-minute chart. But when you're looking at 5-second charts and 5-minute charts and you're looking at a 10 pip profit target or a 20 pip profit target and maybe hoping to get 10 pips, you're looking at the minusculeness of the market. And it's there. The answer is there. The market is telling you exactly what it's going to do in the next 10 pips. 10 pips is a lot of money to a day trader. It's not much if you're up on a daily chart, but if you're trading on a daily chart with an 80 to 120 pip ATR, you're not going to be taking a 10 pip stop. You're not going to be interested in getting out when the 1 minute or 5 minute price goes into a chatter. You're on a daily chart. So where's your risk? Your risk is, I don't know, half an ATR and a half at entry. There's no rules for that. If you set a short stop and you're trading on a daily time frame, then you don't understand daily trading. It's just not going to work for you. When we're talking down on the as a day trader, then you need to be aware of the micro areas of congestion. Not just I'm on a 4-hour chart and I've got a lot of congestion here. Yeah, so what? Maybe that's 30, 40 pips away, 50 pips away from where your entry point is. Who cares? If you get close to that point, like within 10 pips of it, well, you'd start to worry about that because there is a lot of congestion. But what you need to be concerned about is looking at the 1 minute chart for the gyrations. It'll go up 8 pips, it'll come down 5, it'll go up 8. So now you got a 3 pip gain over the last one. So it creeps its way up there, but it's creeping consistently. Once it starts to go up, you're on a 5 minute chart with a 5 period ATR. And the next bar, instead of 5 pips or 3 pips, goes a pip and a half. And then the next bar it comes down half a pip. And the next bar it goes up 3/4 of a pip. And the next bar it comes down 3/4 of a pip. And the next bar, you see what I'm saying? It's chattering. Get out. That's how you execute the most important Forex trading rule, is you get out when the price isn't doing what you thought that it should do based on your theoretical probabilistic estimation of where that price had the juice to go to. If it's starting to stagger, it's probably not going to continue on. And if it does, how valid can that next move be coming off of a chatter event? You know, if you look at chart patterns and stuff, you'd call that a flag pattern, where price is going to go up and then it goes like this, and then a rising flag pattern, and then it continues on from there. Well, what happens if it's a downward flag pattern? I don't believe in flag patterns because you got to look at too many bars to see what's going on. In looking at a chatter, you have to look at a drastic reduction in the ATR in a congested zone. Like the flag pattern shit. You're looking at price action. You're not looking at indicators or whatever. If you are in a position and that price starts to stagger a little bit, then it means it doesn't have the momentum to go up, or it is sensing order flow above it. It senses that now. And it could be that someone who's on a level 2 and can see where all the pending orders are, rather than the executed orders, which are shown in structure, you don't see the pending orders unless you're on level 2. So the folks that have level 2 are seeing where the standing orders are, and they're going, I'm not going to try to beat that. Why would you? But that's like that boulder in the creek, right? So you have to be aware of these impediments to your price action, which during entry analysis looked great. So be aware that the way to execute the most important Forex trading rule, which is to get out of a trade that isn't doing what it should do, is if the price action starts to chatter and the candles become less than an ATR in a short time frame, quarter pip moves, 1 pip moves on a 5 period ATR. Those are drastic reductions in that ATR. That ATR should be running 7 pips. Or I mean, not the ATR. The ATR is generally 5 pips, And now you're seeing bars that are 7 pips. That's moving. That's got some momentum behind it. Now it goes to 8 pips. Now you got some movement behind you. And it could go through the pending order slosh that's out there because maybe that's not strong enough because it's not stopping your price action from moving. And the bank traders are the ones that are creating that movement. So they're on level 2 and they see shit that you don't see. So be aware of the chatter event and just get out. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.